How about defensive stocks like healthcare, utilities, consumer staples like food and beverages? These are fairly recession proof since people still get sick and we still need to eat.
It's not bad, but it's not risk free. And so consumer staples, utilities, all those are still going to fluctuate, even if the market is heading down, or even if we are in a recession, just less so. How I look at that is, well, if the stock market's down 10 and these are down 5, it's still down 5. It just didn't lose as much. So I guess you could say it's outperforming, but it still doesn't do any good for you if you're still going down. So I really like alternatives or principal protected investments to really help out. I really look at things as there's almost three levels of diversification. And one level of diversification is what I call stock diversification. That's entry level diversification. That's where, again, you might have all these different types of stocks like healthcare and utilities, and then you have other equities, and you have a bunch of these that move in different ways, and that's like stock diversification. But then the next level up in diversification, we'll call that level two, would be like alternative strategies that maybe you can't lose money unless a certain threshold is broken. And then maybe the third level of asset allocation or diversification is principal protection. This money is never going to be affected at all. It can still grow, but this money can never be affected at all if the market takes a nosedive. So you almost need to have these three levels of diversification in place, not just one. And so it
Hmm.
goes beyond the healthcare, to utilities, and the consumer staples, because those are still not risk free.
So, what do you think then about dividend stocks and fixed income investments like bonds?
Well, so kind of in the same vein, I'll touch on bonds real quick. That's a good one. So bonds, if we look at just the TLT, you can look that up, ticker symbol. If you have a smartphone, look that one up, TLT. And if you just look at what that did from 2021 to right now in 2025, that's down 40%. That's the 20-year Treasury bond. And so that's susceptible to interest rate risk. So it's not risk free. Dividend stocks are also not risk free either. It's just the nice thing about dividend stocks is it pays a dividend. So if the market goes down, you're still getting a dividend for owning the stock. So you don't feel like you have to sell out of it, because at least you're getting a dividend for continuing to hold it. But what I like better than those is something called structured notes. What I
Mm.
like about structured notes is they can still provide dividend like income, interest income, and sometimes better than the dividends from stocks. But what happens is the risk in it is you're usually insulated unless the market goes down more than 30%, like a buffer, so to speak. So if the market goes down 10%, no big deal. 20%, no big deal. But if the market goes down more than 30%, then you do have risk to your principal. But that's a pretty big drop. And so the nice thing about that is if the markets go sideways and you have strategies like this in place, and you're getting maybe a 6 or 7 or an 8% interest on your money, that can be nice, because you're getting that interest on your money while the market's going nowhere. And then you have this big buffer to the downside that is almost like a protective nature, to where only if the market goes down this far do you have risk to your principal. And so there's some things that you have to look at that's out there. There's obviously, you
Mm.
always want to look at the pros and the cons and the strings attached of everything. But there's different. I just don't want people to think, oh, it's only dividend stocks, because I remember mom talking about that in the 80s, and that must be it. Now there's so many other things out there that people can tap into now.
Right, right.